Hi, my name is Balqish Sofina binti Gafri, number ID BME2311026. Today, we will be presenting about the financial analysis of Aurora Prime Berhad. Let's take a look at the scenario given. Aurora Prime Berhad, a medium-sized company established in 2020. The company operates in the technology and service sector, focusing on providing innovative digital solutions such as software development. Despite showing strong revenue growth over the year, Aurora Prime Berhad faces challenges including rising operating costs, higher competition in the technology industry, and the need to maintain consistent performance for future projects. In this video, we will go through the company financial performance from 2022 to 2024.
Assalamualaikum, my name is Ainina Syarfaa binti Ku Azman and my ID number is BME2311025. Now I will answer question number 1 that starts with current ratio. As we can see in 2022, it shows that company had a healthy current ratio of 1.44 times. But in 2022-23, the current ratio slightly improved to 1.45 times, maintaining a stable liquidity position. The company continued to manage its short-term obligation effectively. However, in 2024, we see a significant drop in the current ratio to 0.77 times. This means the company had only 77 cents in assets. In conclusion, in 2024, Aurora Prime current ratio decreased by 0.68%, which indicate lower its bad. Next, we move to the quick ratio. Quick ratio shows how many times the company quick assets can cover short-term debts. From the table, we can see that the company can only cover 0.56 times its liabilities. This is below 1, which is weak. For the second year, we can see that this is better than year 1, but still not enough to fully cover debts. Then the third year shows the worst year, which is the company now has only 0.38 times of quick ratio. In short, liquidity improved in year 2 but dropped badly in year 3. Next, we move on to the inventory turnover ratio. This shows how many times inventory is sold and replaced in a year. A higher number is better because it means inventory moves faster and sales are strong. For inventory turnover ratio, we can see that in first year, it shows that company get a 3.13 times, and the second year shows the best year, which is get 4.03 times. Means inventory sold faster and sales were stronger relative to inventory. For the third year, it showed 3.25 times, which is slight drop from year 2 but still better than year 1. Overall, inventory management was strongest in year 2.
Next, to calculate the average collection period is account receivable divided by sales and divided by 360. So, for the Aurora Prime Berhad company, for the first year, the average collection period is 130 days, and for the second year is 120 days, and for the third year is 148 days. This shows that the company taking longer days to collect their monies and become less efficient in managing their money. For the total asset turnover, the formula is sales divided by total assets. So, for Aurora Prime Berhad, total asset turnover for the first year is 0.80 times, and for the second year is 0.52 times, and for the third year is 0.47 times. The lower the time is, it is bad for the company because it shows that the company is less efficient in using their assets to generate profits. Now, to calculate for the debt ratio, total debt divided by total assets. So, for Aurora Prime Berhad, for the first year is 52%, and for the second year is 53%, and for the third year is 65%. The higher percent debt ratio is bad because it shows that the company rely more on borrowing the money, which are risky for the company.
Assalamualaikum, my name is Daffina Alya binti Che Ayob. My number ID is BME2311041. So today I will explain about time interest and ratio and net profit margin. Both of these ratios are important to measure a company financial performance. Now I will explain about time interest and ratio. The time interest and ratio is calculated by divide earning before interest and tax with interest expense. For the first one, as we can see, earning before interest and tax is 300,000 and interest expense is 60,000. So 300,000 divided by 60,000 equals 5. For the second one, earning before interest and tax is 320,000 and interest expense is 65,000. So 320,000 divided by 65,000 equals 4.92. For the last one, earning before interest and tax is 190,000 and interest expense is 18,000. So 190,000 divided by 18,000 equals 2.38. This ratio shows how many times a company can cover its interest expense with its earnings. A lower ratio is bad because it means the company might struggle to pay interest. Okay, next is net profit margin. The formula is net income divided by revenue then multiplied by 100%. For the first year is 118,000 divided by 2,500,000 equals to 7.2%. For the second year, 191,300 divided by 2,700,000 equals to 7.09%. For the third year, 82,500 divided by 2,1600,000 equals to 3.17%. The net profit margin shows how much profit the company earns from its revenue. The higher the percentage is better, the lower percentage is bad because it means less efficiency. In conclusion, for both ratio, a lower value is bad. The time interest and ratio should be higher to show strong ability to pay interest. Net profit margin should be higher too to show the good profitability.
Here we are looking at the company's profitability in terms of return on asset and return on equity. First, return on asset. These ratios show how efficiently we use our total asset to generate profit. In the first year, ROA was 0.036% and in the following year is slightly improved to 0.037%. Although these small percentages are very small, they are still higher than the industry average of 0.015%. It shows that even with a low overall profitability, companies are using their asset a little more effectively compared to competitors. Next, return on equity. This ratio measures how much return we give to our shareholders based on their equity. Company ROE was 0.075% in the first year and increased slightly to 0.079% in the second year. The industry benchmark is only 0.04%, which means the company is providing better returns to shareholders than the industry average. In summary, both the ROA and ROE figures are still very low, showing that overall profitability is weak compared to the size of our asset and equity. However, when we compare to the industry, they are performing slightly better. This is a positive sign, but it also highlights the need to focus on strategies that can improve their net income going forward.
Now, we will go through the financial ratio analysis of Aurora Prime Berhad for the year 2022, 2023, and 2024. Now, let's take a look at the liquidity ratio. First, current ratio. For the year 2022, the current ratio of the company is 1.44 and for the year 2023 is 1.45, while in the 2024, the current ratio decreased to 0.77, which may shows that the company had struggling to pay its short-term debt. Next is quick ratio. For the year 2022, the quick ratio is 0.56 and for the second year, increased to 0.78, but in 2024, the company quick ratio decreased to 0.38, which may shows that Aurora Prime Berhad is short in quick assets to cover its short-term liability. Next, efficiency asset management. The company inventory turnover for the year 2022 is 3.13, and it started to increase for the second year, which is 4.03, which showing that the company managed their stock very well. But in 2024, the company inventory turnover decreased to 3.25, showing that the company stock is moving slower. Next, let's take a look for the profitability. The company net profit margin for the year 2022 is 7.2%, and it started to decrease for the second year to 7.09%, and for the third year, 3.70%. This shows that the company made less profit from their sales. Next, return on assets. For the first year, the company return on assets is 0.036%, and for the second year is 0.037%, and decreased for the third year to 0.050%. This shows that Aurora Prime Berhad used their asset less effectively to make profits. For return on equity, for the first year, the company return on equity is 0.075%, and it started to decrease for the second year to 0.079% and continue until for the third year, which is 0.04%. This shows that Aurora Prime Berhad is making less profit and become less efficient on generating profit from their shareholders' equity. Now, for the company debt ratios, for the first year is 52%, and it started to increase for the second year to 53%, and for the third year is 65%. This shows that the company borrowed more money to finance their assets, operations, and for the company growth. Lastly, for the Aurora Prime Berhad time interest earned for the first year is 5%, and for the second year, it started to decrease to 4.92% and continue to decrease for the third year to 2.38%. This shows that Aurora Prime Berhad had less ability to pay its interest expenses from their profits.
Now, let's move to the question 1.3. The three initiative action to improve the financial performance of the company in the future is to control costs better. Aurora Prime should reduce unnecessary spending and use resources more efficiently. For example, they can negotiate a lower price with suppliers or use technology to save time and money. This will help the company keep more profit. The second one is manage debt wisely. The company has high short-term debt and interest costs. Aurora Prime can try to refinance loans to get lower interest rates or pay off some debt using retained earnings. This will reduce financial pressure and improve profit. So the last one is increase revenue through new markets. Aurora Prime should offer more digital solutions like cloud or AI services and expand to a new local or international markets. This will give the company more income and make it less depend on one source of revenue.
Now I will explain for the question 2. For the current ratio, Aurora Prime Berhad has a current ratio of 0.77 times, which is much lower compared to the industry average of 2.2 times. This indicates that the company may face liquidity risk because it has less ability to cover its short-term obligation. For the quick ratio, the quick ratio of Aurora Prime Berhad is 0.38 times, while the industry average is 1.4 times. This shows that the company relies more on inventory to meet short-term liabilities, and its liquidity position is weaker compared to the industry. For the total asset turnover, Aurora Prime Berhad records a total asset turnover of 0.30 times, while the industry average is 56.7%. This means that Aurora Prime is less efficient in generating revenue from its asset compared to the industry. Next, average collection period. The average collection period of Aurora Prime is 148 days, which is longer than the industry average of 105 days. This means the company takes 43 days longer to collect payment from customers, showing slower receivable management. Next, the last one is debt ratio. Aurora Prime Berhad has a debt ratio of 71%, which is slightly lower than the industry average of 75.3%. This indicates that the company is slightly less leveraged compared to the industry, meaning lower reliance on debt financing.
Based on the calculation, in 2023, net income of Aurora Prime Berhad had increased by 30%, while revenue remained unchanged. The net profit margin could arise from 7.09% to 2.16%. This allowed the company to be more efficient in controlling costs because it can generate higher profit from the same level of sale. High profit margin can give an improvement on sustainability, cash flow strength, and can make the company more competitive compared to the industry.